After 30 years of stagnant growth, the Japanese equity market is seeing intense activity. A wave of structural reforms is currently driving new performance. In February 2026, Prime Minister Takaichi secured a supermajority, allowing the implementation of Sanaenomics. Her administration has since initiated an aggressive schedule of fiscal expansion and strategic industrial investment. This chart shows nearly half of the Tokyo Stock Exchange trading below a price-to-book ratio of 1. To correct this, the exchange mandated improved valuations. Corporations responded by deploying cash reserves, driving stock buybacks to 12 trillion yen, and increasing dividend payouts 167%. That return of capital drew heavy foreign institutional interest. Warren Buffett amassed large stakes in 5 major Japanese trading firms, known as Sogo Shosha. This graph tracks the cumulative total return of those 5 specific trading firms. Since Buffett's investments were made public, these companies have comfortably beaten the broader returns of the S&P 500. Japan's market profile has shifted. Driven by targeted state support and strict corporate governance mandates, the nation is actively rebuilding its economic engine. That engine relies heavily on external demand. Japan is the 3rd largest economy in the world, largely because consumers outside its borders buy its exports, and those exports become more competitive when the Japanese yen is weak. This creates a structural trap for international investors. The very same currency weakness that boosts corporate earnings simultaneously erodes the value of those returns when converted back into US dollars. This chart illustrates international equity volatility. Look at the light blue segments. Unhedged currency exposure adds substantial risk, increasing overall portfolio volatility by up to 4.6% over a 5-year period. This bar chart breaks down calendar year returns from Japan's foreign exchange. Over the last 3 decades, yen returns have varied widely, with deep negative years heavily compounding equity risks for foreign buyers. To participate in Japan's export boom, an investor traditionally has to absorb the unpredictable and often destructive swings of the currency market. The WisdomTree Japan Hedged Equity Fund, ticker DXJ, operates as a mechanical solution to this problem, isolating the upside while neutralizing currency friction. The fund begins by screening the broad market, targeting only dividend-paying companies with a market capitalization greater than $100 million. Next, it applies an exporter tilt. This filters out companies that rely primarily on the domestic Japanese consumer. A company is only included in the index if it derives less than 80% of its revenue from within Japan. Finally, the fund applies a static currency hedge. Using forward contracts, it mechanically neutralizes the fluctuations between the US dollar and the Japanese yen. The result is a concentrated basket of global industrial and financial powerhouses. DXJ functions as an active sieve. It extracts the yield of Japan's export economy and insulates it from currency losses. With nearly $6 billion in assets under management, the fund offers deep liquidity and a broad exposure to over 400 holdings. This graph compares the relative forward price-to-earnings multiples of MSCI Japan against the S&P 500. The jacket blue line remains deeply below the baseline, showing that these equities are still trading at a significant discount compared to elevated U.S. markets. A common assumption is that protecting a portfolio with a currency hedge creates a persistent drag on overall performance. That assumption ignores the cost of carry. When you hedge using forward contracts, the cost is determined by the interest rate differential between the 2 countries. This chart maps the annualized carry rate. Notice the dark blue line spiking upward. Because U.S. policy rates are currently higher than Japan's, investors are earning a positive yield simply by implementing the hedge. The current macroeconomic environment subsidizes the protection. Investors are effectively being paid to shield their capital from the yen. Looking forward, the Takaichi mandate has established 4 specific pillars of state support that provide a direct tailwind for the fund's underlying assets. Government spending is heavily targeting defense, while industrial policy is actively subsidizing AI, semiconductors, financials, and major global exporters. However, this architecture carries inherent vulnerabilities. DXJ focuses its investments entirely within Japan, amplifying the impact of localized political or economic events. The exporter screen also creates portfolio concentration. The fund is heavily overweight in the industrial and financial sectors, making it sensitive to shifts in global trade volume. Furthermore, the currency hedge relies on derivative instruments. If the Bank of Japan aggressively increases interest rates, the positive cost of carry could compress, altering the mechanics of the hedge. While the ETF is engineered to capture the current state of Japan's economy, any sudden reversal in domestic monetary policy or international demand could disrupt its momentum. The bull case rests on momentum. This is a purpose-built architectural solution designed to capture Japan's most significant corporate governance reforms in 60 years and an ongoing export boom. The bear case points to the risk of single-country exposure, where any slowdown in global industrial demand directly impacts the underlying equities. Does a mechanically screened currency-hedged engine belong in your diversified portfolio? Share your verdict in the comments below. And don't forget to like and subscribe for more deep dives into market mechanics. As always, this video is for educational purposes and is not financial advice. All investments, including ETFs, carry inherent risks, including the possible loss of principal.